Patrick Leeson. This wasn't planned, but we're actually an investor in GoodCap and Hub, and we really excited about the triple bottom line approach and excited about the expertise that they bring to the table, as well as the empowerment and education that you provide. It's very important. So, for lack of a better term, I run an investment group for a single family up in Napa, the Meyer family, and they had an exit out of the wine industry back in 2001. And out of that exit, they basically diversified their portfolio using a traditional money manager that just spread it across different asset classes, which was fine. It worked for them. But soon after that, Bonnie, my boss, her husband passed away, and she didn't like the fact that there wasn't a connection to the investments, and she wanted to do more with the investments. And so I had always worked for the family, and she said, I want to do good with our money, not after the fact, via philanthropy, because we can't create money and give it away after the fact, but I want to do an investment directly so that we're doing good while that company is alive and well, and it's also providing us with a financial return. So we didn't know that it was called impact investing. But we hope in time, by 2020, our entire portfolio will be invested in the impact space. We said that's great, but where in the heck are we? Do we even know where our portfolio is? So what we did 2 years ago was we wanted to establish a baseline, and we ran into a gentleman by the name of Paul Herman at HIP Investor, which is Human Impact and Profit, to be able to establish metrics for our private portfolio and our public portfolio using health, wealth, earth, equality, and trust. And we put all of our holdings through that scorecard process, and we established a baseline score. So we had no idea where we were, but out of 100 Meyer Family Enterprises, it's private equity and it's public equity, private and public, ended up being 64% already invested in the impact space. I think we got pretty lucky. But we were just doing things that we thought were the right investments and providing us with a significant return. So let me real quick show a couple of slides. So I'm not going to go through this, but what we have found as a family is that in order for us to be targeted in the impact space, we first wanted to know what our target was. And it's renewable energy, it's clean tech. But we also realized, working with our traditional advisors, is we needed to have an investment policy statement that clearly highlighted our interest in impact investing. Because the traditional money managers don't respond to anything other than an investment policy statement. But what we said is that we want to minimize the negative impact to the environment, and we want to maximize the profit and the good. So we actually embedded an investment policy statement with impact, and actually it's received some traction. So through the HIP scorecard process, we went through and we evaluated how are we currently invested, and with a score of 64, what do we need to shift into and what do we need to shift out of? So this is just a graph of how we have moved out of some things and into others. You'll see that sustainability became a larger part of our portfolio. Our fixed income has pretty much stayed the same. We're lowering our U.S. diversified, but we also see a huge opportunity in working with venture capital. And Bonnie, as an entrepreneur, loves the venture capital model, but we also realize that it's going to kill us if we're not smart about how we invest in venture capital. Because from a liquidity perspective, we're new to the game, and it's great to invest in smart entrepreneurs, but exits take a long time. So we are being mindful about how we work with private equity and venture capital. And we're starting to work with the experts. GoodCap, for example, we don't have the in-house expertise to look at and due diligence all the deals. They do. Let's invest in them, leverage off their expertise, and see if we can partner with them. So this is a list of what our current allocation looks like across, and coming out of the HIP scorecard process, where we need to go, what we're going to shift out of. And I'm moving very quickly because we have 10 minutes, but I'm happy to share with you the case study results we're soon going to publish, on our website, mfenterprises.com, so this will all be there, so don't worry about capturing everything. So we realize now what we need to shift into, and we're going through that process right now as we speak, working with a new group of advisors. We had, again, a traditional investment money manager for 20 years, but after continually asking for impact opportunities, he couldn't provide us with any. So we made a change. So we're now working with 2 advisors that have impact investment as underlying themes, and it's been very helpful because we're working with them as partners. This is just a scattergraph of where we are on the public portfolio side. You want to be in the far top right quadrant with regards to human impact and profit. And our muni bond portfolio actually is the most hip out of everything that we have on the public side. We found he looked at every investment that we have, and our muni bond portfolio was the most impactful. Our private equity, you know, there was a discussion earlier on the panel about 5, 10, 15x. We're pretty modest. We hope that we have a return over time, and we hope that it's sustainable. Our hope with our investments on the private equity side, as Wes mentioned, how do you invest in private equity groups so that you don't have to plan on an exit, but you can plan on a distribution stream coming out of that company? Dividends, interest would be fantastic. We're young, so we haven't had an exit yet, but we do have one company that we're working with investing in that's close to an exit. So that's pretty exciting. We try to be clear and transparent about all of our investments. So we post everything that we do on our website, which is, again, is meyerfamilyenterprises.com. We have bios and links to all our companies, as well as the founders of the companies, to give people an idea of what we're trying to target. And that's just the scorecard of the private equity portfolio. Our impact and where we want to be. Again, we've grown up as investors. Bonnie is an entrepreneur at heart, and 5 years ago, she was all over the place, really excited about investing in things. So we were reacting, we weren't planning. Now we're planning, and that's really helped us. We have a joke in the office that she's the good cop, I'm the bad cop, because she goes out and has conversations, and then she comes back and says, I have to look at it, do the due diligence, and if it doesn't work, Patrick, you go tell them no. So that worked. She should be out there networking. She's very passionate about this, and she's viewed as a leader in the impact space. So the other thing, when I say that we've grown up as investors, we no longer react to things. When we are approached with an investment opportunity, we now use a screen or an evaluation tool called the HIP check. And what that is basically a checklist that those companies, when submitting a proposal to us or an investment opportunity, they have to complete it. It's 5 pages. How's your management being run? What's your diversity? How profitable have you been? Health, wealth, earth, equality, and trust are the drivers. So they have to complete this in order for us to even consider them as an investment opportunity. So it screens them out pretty quickly, and also provides us a streamlined opportunity to connect with them. And that's it. So more than happy to cover questions after the panel.
Myers makes really good report, right?
They do.
Yeah.
They do. And Ms. Rum.
Yeah. Great learner. Can I actually take a microphone? Because I actually
Yeah,
I
get
can't
up,
see the
run
screen
around.
from where.
You said you were going to stand on the table, and might hold you to it.
Only if you get up here with me.
Oh, okay, then we better not. We're in platforms.
Is there a microphone that actually pulls
This
out?
one can probably come out a little ways, not too far.
I'm not
That's a
gonna.
short leash. Wireless would be better. There you go. This is actually not for everybody here, it's for me because I can't actually see the screen from where I'm sitting. So as Gene said, we've got a sort of diverse array of panelists here, and especially being at a venture summit, I think I may be as diverse as it gets because we're actually a late-stage private equity firm. We've been around for a couple of years, but I think that there is real value in what we're doing and how it's applicable to investors of all stripes, whether you're in venture or on the LP family office side or even in big corporate, because as I'll share toward the end of the presentation, we're taking an approach where we're integrating environmental sustainability principles explicitly into what we're doing. So yes, we're out to make profits, make returns. We're positioned in the marketplace to be really focused as market-based private equity investors, but we believe that there's an opportunity to integrate sustainability as a way to create outsized returns. To make this work. So the first thing is that because we're a fund in formation, we started the business a couple of years ago. I have to make you all stare at the disclaimer. Read this later. But the point is that we're a fund in formation. We're raising a $300 million fund, but I'm not here to sell anybody anything or to offer or to solicit an offer. Now, in terms of what we actually do, we've been around for a couple of years, and our focus, again, is lower middle market private equity. So this is distinct from venture capital in that we're focusing on companies that have already proven themselves in the marketplace, that are already past the point of having to scale up or prove their technology works. These are companies that are already profitable, where we can actually look to, as Patrick was saying, look to cash flows, look to ways of structuring and integrating debt, for example, where there are opportunities to really leverage off these companies' profitability. Now, where we distinguish ourselves is that we're focused on resource productivity and environmental sustainability. And this is different from kind of the broad-based clean tech, green tech movement we've seen in the last few years, because we're actually actively integrating some real thoughtful analysis into what we're doing. Now, the team comes with an extensive background in the strategy we have generated previously in our old funds, 33% IRR investments over the last 10 years. We've got a team that's global. We are based in San Francisco here downtown, and also in downtown Amsterdam. And again, we're focused on really those companies. We're not trying to go out and invest a small amount of money in a new company and hope to get the next Google. We're really looking for consistent returns across an entire portfolio. It's very different from the ventures that a lot of you are potentially involved with. My partner Alex and I both come out of having most recently worked for multi-billion-dollar funds where we have backgrounds in energy and environment. And he and I had gone to business school together at Harvard and had, over the years, been in touch, saw that there was a really interesting opportunity where on both sides of the Atlantic, there were companies starting to emerge that were green, but were really kind of below the radar of the big private equity funds that we were involved with, and that were less risky than what the venture capitalists that we're focusing on. So we started the business a couple of years ago. We've been very privileged to recruit people who have a lot of deep backgrounds in the relevant areas in energy, investing, and policy. And we're off to the races, having completed our first deal, which I'll share a little bit about shortly. Now, I'm sure everybody in this room is fairly familiar with what the big drivers are. We've all been following the news, aware of the fact that there are big commodity pressures coming on the pike, where we've seen energy prices, food prices rise to unprecedented levels over the last couple of years, driven largely because of demographics, as we see populous nations urbanizing, going to more robust middle classes. Geopolitics, we're all well aware of the fact the U.S. is now fighting on a third front, and there's some deep and broad issues going on there. And then the broader issues of environmental degradation. I had the privilege of attending Halt's water business plan competition a couple weeks ago, and for all of those of you who missed it, really interesting to see how there are sleeper issues like that, in addition to the ones like global warming, that are really taking the fore and impacting markets. This is leading to, I think, with prices doing what they're doing in the marketplace, a real demand for resource productivity, for ways to go and achieve the goals of satisfying the market, satisfying demand worldwide, but doing it in superior ways. And it's affecting sectors that really are the core of the economy: energy, transportation, water, food, and agriculture. But it requires, to play in these markets, it requires a level of expertise that is really specialized. And I think this is an error that people have made in the last several years, jumping into clean and green, thinking that as software entrepreneurs or as technology venture capitalists, they suddenly knew what it took to go and play in the same marketplace as ExxonMobil. And it's a very, very different type of market. This is where we think that there's opportunity. As I mentioned, the market's been maturing, so much so that late-stage private equity has actually been rapidly eclipsing venture capital as an opportunity.